Hello and good afternoon, everyone. We'd like to welcome you onto this month's event on holding companies. It's great to host everyone today. Great to see so many coming on. So if anyone's got any technical issues, please feel free to contact us using the chat function. And we will be having a question and answer session towards the end of the event. So please feel free to post your questions in the Q&A box at the bottom of your screen as we go through, and we'll pick these up and address these later. So just to introduce ourselves, my name's Angus Brewer. I'm a consultant here at Oldfield, and also on the panel this afternoon we've also got Jack Bennett, one of our tax consultants here at Oldfield. So we're here today to talk about holding companies and explaining what they are, what they can be used for, and when you might need one. And we'll also cover some of the key tax considerations in having a holding company infrastructure, and then also some practical points of how to get the most out of it. So first off, before Jack is going to go over the some of the reasons for having a holding company in your structure, let's have a look at what one is actually in practice. So a holding company is a separate parent company created, and what it does is owns a controlling interest in subsidiary companies. So normally a holding company itself doesn't do any trade, but it owns shares in companies, subsidiary companies, which they will often be doing the trade. So let's just look at a diagram on this. So I guess in a standard limited company, usually you'd have individuals as the shareholders of your trading limited company. But what happens with a holding company is basically it's like almost like this personal shareholdings moving up a level. So you've got a trading company, which is then owned by a holding company, and then the individual shareholders, as individuals, are shareholders in the holding company. So I guess this type of diagram that we're showing on screen is what we would typically refer to as a group structure. And there are certain things that can be done within a group structure, as opposed to having, multiple standalone companies dotted around the place that you might own as individual shareholders. So if you need multiple entities, there can be some advantages and a bit of a neat way of consolidating those in together as a group structure where applicable. I guess a key part to a holding company and the concept really is allowing businesses to separate the trading risk. So you've got trading risk in the trading companies, but then you can separate that from the valuable assets and also the shareholders' personal investments, which are held in the holding company. Obviously, there's quite a number of extra and additional things and outcomes that we can use a holding company for, which Jack will cover in a minute. But just to really focus in on this protection point, I like to think of it as a bit of a barrier of protection from your trading company by having that holding company in there, and you can see that on the slide there. So I guess you might say, well, what do you really mean by a trading risk? Well, I guess trading companies, we're in business, they do come with a general inherent risk that, a company could be sued for goods or services provided. There could be some customer claims, there could be some employee litigation claims, and these risks are actually real. And I guess, obviously, it sounds would be quite an unfortunate situation to have a claim like that. But just in practice, if the company didn't have enough cash or enough assets to settle its debts, then the company could actually be forced to sell its assets and may not generate the expected level of proceeds as if the company was naturally sold or those assets was naturally sold. So I guess what normally happens in that situation is the proceeds generated would be used to pay off the creditors of the company, and then shareholders, what's left for them is only literally left what's in the pot at the end of all of that. That might sound a bit extreme, but I guess what we're really saying is the holding company is a way of business owners using it to separate those trading assets versus those valuable assets or excess cash from the general risks within the trading company. And if the worst was to happen and the trading company was sued or some claims against it, only the assets of the trading company can be liquidated, and the assets in the holding company are protected in a general sense. So that's why I think holding companies are quite a key part really in terms of asset protection and planning. So I think we just wanted to cover that off as a starting point. But I think it's over to you, Jack, now as to some more reasons why you might seriously consider a holding company when you might need one.
Thanks, Angus. That's useful background. So I just wanted to drill down into both the why and when you might need a holding company in your structure, and really go over some scenarios that might make you consider whether it's appropriate to include a holding company in your structure at this point or at a certain point in the future. Now, holding companies are extremely versatile entities, so there are a number of situations where a holding company can be part of the solution to your needs. But I do want to just emphasize, however, that it may only be part of the solution. There could be more advantageous routes, or maybe other options that will dovetail in nicely with a holding company. So first scenario that you might be looking to introduce a holding company is what we went over in our last event, which is where a holding company can be used very effectively to buy out an exiting shareholder. So whether this be a full exit or a management buyout, or just even a partial exit out of the company as part of a succession planning exercise. Now, we've got a number of these projects in progress at the moment. And for example, there's one where members of a management team are looking to buy a large shareholding from the founding shareholder. Or we've got a few projects where the founding shareholder is no longer actively working in the business. And so this is being used as a method to buy the founding shareholder out, either in entirety or just down to a small minority shareholding. I think really it's important that that is a very key succession planning exercise. It allows the next generation or the ongoing shareholders to really increase their shareholding of the growth. And as was covered on the last event, this can be particularly beneficial where the shareholders that are taking the business forward, so the continuing shareholders, don't necessarily have the ready cash to purchase the shares from the exiting shareholder. This allows we've developed the holding company buyout solution, which enables the continuing shareholders to use the company's cash and future profits in order to buy out the exiting shareholder. And we can also do that whilst eliminating the stamp duty and protecting the proceeds from inheritance tax. So another reason for adding a holding company into your structure is what Angus already briefly touched on in relation to providing legal protection for valuable assets held in the trading group. So by valuable assets, we could be referring to a commercial property, or you could be looking at large piece of machinery, or is often the case and perhaps overlooked is surplus cash and profit reserves. So family companies should really be regularly moving surplus profit and cash up to your holding company in order to protect and maintain this wealth. Now, I would just note on that you do need to ensure that you've got proper dividend records in place for these amounts. You can't just make the payment, which I think Angus will come on to in a bit. So really, your holding company should really be viewed as your family wealth company. So that's where you hold the bulk of your wealth. And the main reason being this point that Angus has covered, where this wealth is then outside of the trading risk associated with your trading company. Now, we'll just note, however, that there may be some further options or different options to be considered, particularly in relation to commercial property, that may be more advantageous than a holding company. So it's not necessarily the solution for everyone. Now, as part of this idea of using your holding company for your family wealth and investments, this can be particularly pertinent in situations where you're looking to separate out different trades from your existing trading entity. So it might be that you have a different division of the business that you may be looking to sell on in a few years' time. Now, you're often best to separate this out of your existing trading entity significantly in advance of a sale. This has a number of effects. If nothing else, it can streamline the sale process quite significantly because there's clear, separated accounts and records for the different businesses. There may also be some tax advantages available in these circumstances as well. But again, as long as you do this reasonably in advance of actually selling the business. And a scenario that we've seen become increasingly common over recent years is relating to employee share ownership. Now, many business owners that we're speaking to are looking to bring in the key employees into ownership of the company. Primarily, that is for incentivization and retention, really, so to keep those key employees with the business. But in these circumstances, there can be a whole host of reasons why a holding company facilitates this very well. And the main benefit is that this allows you to keep your family investments separate from any employee ownership. So it may be surplus cash reserves, or it may be private loans or investments in other trading entities, in property. Whatever it is, you'd usually expect that the employee would only benefit from the growth they bring about in the trading company, the company they're working in day to day. So having a holding company allows you to really draw that distinction between what's the trading business and assets and what is the family's private investments and assets. Now, we're just in the process of completing a restructure like this, where the main shareholder has a holding company in place and they've got some property in this holding company, which they are currently renting out. Now, the holding company allows this position to continue without the employees having any involvement in these property investments. So brings in the employees, retains them, gives them a skin in the game, gives them some real value in their shares, but they don't have any access to the property investment. And the holding company can continue to be funded by the trading company profits as it continues. Once you've got these basics in place, you can really use this structure to leverage the flexibility, and you can really look to take it to the next level. And so some of the other structures that we've implemented over recent years, this has worked really well, include things like joint ventures, for example. So using holding companies in joint venture structures really allows you to build a fully functioning joint venture structure. So it's one that works for all parties and not only takes into account the tax consequences, but also other aspects such as the fairness or the distribution of profits. You can really use the holding company structure to leverage that. We've recently worked on a joint venture structure where there was actually 3 separate investor groups. So you had the original family owners and then 2 unconnected investors. By using these holding companies, we've been able to design a company structure that both enables the initial investment, so that enabled the release of funds for the existing family shareholders, and then builds a future-proof structure from which the parties can work together, generate funds, and then reinvest the wealth that they generate. Another structure that would be used using holding companies like this specifically relates to a year when a trading company makes excessive or what you might call one-off profits. So the level of profits that you are not likely to repeat, and often it's preferred if this cash and profit could be moved off the balance sheet of the trading company into an entity that doesn't publish an annual balance sheet, so retain confidentiality as to these amounts. Now, this is possible, and we've done this, but it's not necessarily straightforward. And I think the important point to note is you need to make sure that this is completed in the year in which the profits are made. So year in which you make those exceptional profits. We've also used the holding company concept to go further in situations where there are surplus cash reserves in the holding company, there are perhaps a larger group of shareholders. Now, in these circumstances, you'd often find that different shareholder groups have different priorities as to what to do with the surplus cash. So, as an example, based on situations we've seen, you may have 4 brothers that have been in business for many years, and they've built up this successful business. They've got surplus cash reserves. Now, all the owners are fully committed to continuing in the existing family business. None of them are wanting to split off onto anything else. But they've just got different ideas on what they should be doing with the surplus funds held in the holding company. So you might have one family that want to build up a portfolio of commercial property. Another might be looking at developing a plot of land. Others might want to invest in minority shareholdings in completely different businesses. Or some others might just want to use the funds to provide cheap loans to friends, for example. Now, in these circumstances, it can be quite difficult to get everyone to agree on the best way forward and achieve everyone's objectives. So we can look at options to introduce separate investment companies for the various family groups. And this then allows the surplus cash to be divided up, and then each family group is then free to invest their share of the money as they see fit. Now, with all of these options, there are number of significant taxes to be aware of. And really, each circumstance and business is unique in how these taxes can impact the transaction. Each business, each property, and each restructure are unique, and they will have their own particular variances. I suppose the point to make is that before you take any action in relation to any of the scenarios I've gone over or similar scenarios that you might be facing, you need to get good quality professional advice in relation to your restructure and to make sure that you're definitely working that in the best way. I think it's really important to highlight that the tax consequences on these transactions can be significant. So, for example, if you've got a VAT liability on a commercial property worth £1 million, that's £200,000 of tax. Or if your company is worth £10 million, for example, then you could use an alternative route to restructure your company that might save you stamp duty of £50,000. So we're not talking about small amounts here. We do unfortunately see situations where proper advice hasn't been taken. And not only can it leave missed opportunities, but it can also incur significant tax liabilities. We had a situation recently where a holding company had been introduced into the company structure, but because this hadn't been done effectively, they actually had a whole host of potential tax problems that they weren't even aware of. I mean, to start off, none of the shareholders qualified for business asset disposal relief, and they'd lost a lot of their group relief for capital gains tax, stamp duty, land tax, and inheritance tax. And just to put some context around, the business asset disposal relief problem alone came with a potential tax cost of £400,000. So hopefully this has helped to really highlight some of those scenarios where a holding company can be effectively used in your structure to really achieve the aims and objectives of the shareholders involved. So over to you, Angus, on how to effectively use the holding company once we've got this included in our structure.
Great, thanks, Jack. That's really good to get an understanding of those opportunities and those tax considerations too. As you say, just needs that advice and managing to get it right. So moving on then, so once we've got a holding company, what else should we be thinking about and in order to use it to the best advantage and really make it work for us? So one of the points that Jack's already touched on is the key principles to consider is the concept of moving profits and cash up into the holding company. So as we remember, the holding company represents a great opportunity to separate those valuable assets, and obviously surplus cash can be one of those. And what we want to do is protect that surplus cash from the trading risk, as we've already covered. So how do we actually move cash into the holding company? You just need to remember that our holding company is a separate, distinct legal entity from the trading companies. So we looked at that barrier of protection, but even from a simple mechanism perspective, just think of it like a fence almost, between those two different entities, and you can't just sort of throw something over the fence for no reason. And I guess the point of saying that is that we really regularly do come across some situations where talking to new or prospective clients, for example, where they just treat the holding company bank account, they might have a bank account in the name of the holding company, but they just treat it almost like just another deposit account that's used in the general mix of their cash. Well, when it comes to cash in that situation, please don't just use the holding company just like a sort of a standard deposit account, you might say, that just kind of, if you've got a bit spare, you park it in there and then take it out again for a tax bill, for example. It doesn't quite work like that, and that's not the best way of doing it. What you need to think about is an actual mechanism of physically declaring those dividends out of profits in the trading companies up into the holding company. And those dividends are tax-free between the companies. And then you need to pay those dividends up, or can do, in physical cash. Otherwise, if you literally just move the cash up into the holding company, it doesn't actually achieve that barrier protection because there's no reserves, etc., in that company to back it up. So that's really important. Well, that's the only way of getting that protection is by having a proper mechanism for that. Now, one thing to throw in here is ensuring that the credit rating of the trading companies is considered in doing that exercise. So that just needs a bit of care and planning. to make sure that's done in the best way. And whilst on the point of credit ratings, having a holding company does actually give you a bit of flexibility in terms of those profit distributions, and that actually gives you a bit of a potential way to smooth out, you might say, those trading company reserves a bit, to ensure there's no detrimental impact on your trading company's credit ratings. So, for example, you may have a bumper year one year, and then if you draw all that money out next year, and it's not so profitable, that can have a detrimental effect on your credit rating. So, holding company is one option that could be used to help with that. So, as Jack mentioned earlier, if you get to a stage where you're almost having the holding company as the family element, you might say, or family company part of this trading structure which you're building up, you can then start to think about other elements you can use that cash and profits in the holding company for. So, for example, maybe loans to charities, maybe other individuals and friends that Jack's mentioned, maybe able to actually be made out of the holding company. And it just keeps the trading company actually quite nice and clean, away from some of those elements. However, just a quick note on that, just need advice on loans from a company to individuals. Just make sure you don't fall into any tax traps on that one. For a number of our clients, we've also inserted what we call a family wellbeing trust, which is something we've developed as a vehicle which can support grandchildren and their life needs. But again, it all can be sort of done out of the holding company, so out of profits and cash in the holding company, as opposed to sort of muddying the waters, you might say, with the trading company. So, why not put those family wealth and funds for good use for the benefit of the wider family and other needs as well, such as welfare support, etc. So, just another few other practical aspects. Firstly, you may need to consider actually having some verified set of financial or management reports, management accounts for the holding company, perhaps once a quarter. So you can actually report on that true equity position. And you can get clarity as to what funds and wealth is actually in your holding company. So as you start to use it more, and as you start to really make it work for you, you just need to remember that it kind of becomes another part of your wealth and funds and equity in the structure, and therefore it needs proper reporting. And what that means is if you're going to do reporting on your holding company, you probably need to keep some records, or you will need to keep some records. And again, our recommendation is if you've got a bank account, certainly in the name of a holding company, we do say that you should really have a simple accounting system, even something like Xero or something like that or if you've got another ERP system that you're using, you may have another company license you can use, but it's essential to have that extra record keeping in that system just to keep track of all the transactions. And also, you may even need to do some back returns, maybe, depending on what that holding company is doing. But it just means that ultimately you can have that clarity of the reporting, and also flowing then onto what we would call an equity statement. So that's another key part of this in terms of making the holding company work, is actually having this equity reporting and an equity statement. So I guess it's really a myth in a way that tracking your personal equity in a limited company is difficult. That's not necessarily the case. It's not the case. It's important, in our view, to create an equity statement that clearly shows each owner's stake in the business at any given point. Now, this provides clarity, helps track your personal equity, and also it motivates, as owners to see that equity growing. And it becomes even more crucial once we've got a holding company involved to manage that. And I think, not to labour the point, but I don't think we can really stress enough how important having this picture of your true equity really is. With the company structure, I guess can get quite complex, or feel like that, with various pots of money, you might say, with retained earnings and dividends and directors' loan accounts and goodwill, etc., etc. The list goes on. But the key thing is, that's something we're really passionate about, is just distill down everything into what your real true equity position is, cutting through the complexity. And then it's about allocating that true equity position amongst all of the shareholders, so every single stakeholder, every owner knows exactly what their pot and their stake is in the business at a given point. And we've actually had clients come to us recently, almost purely because of this equity reporting that we're doing. And it's just interesting to know that, for another client that's just come on board, we've been through this exercise, and it's been completely eye-opening for the shareholders to see what their pot really is. They had some ideas of their own of how much of the business they thought they owned. So and so only he owns 30% of the business, and so and so owns 20% of the business. But actually, when we worked through this reporting, worked through all the elements, it was actually quite different in reality. So I think it's just ultimately, it's all about achieving that clarity. So that's something that you can utilize and put in place with your holding company as in your group structure. So I hope that makes sense. Just a few practical points. So where do we go from here? So I guess there's a right way and a wrong way to do everything in life. And if you're not quite sure where to turn to next, then do come and speak to us. And these points here, do you have any of these significant events that Jack talked about on the radar? Maybe you're thinking about buying out another shareholder. Maybe there's a succession move. Maybe there's some valuable assets, property, cash, etc. that need protecting. Maybe there's a bit of a diversifying of some interest, so maybe some splitting out some business trades. Or maybe you're thinking about employees having share ownership. Or it could be it's just actually about establishing whether your current structure is really fit for purpose. Maybe just having a refresh on that. Are there any tax pitfalls? Are there any opportunities? Or you might actually already have a holding company in your structure which is just set up and is there but not really being fully utilised. So I guess it's just really, if you are in any of these situations, then you feel free to speak to us, have a discussion. On the follow-up email, there will be a register your interest link in there, and if you would like a conversation, then please just do click on the link and we can have that discussion and where you're up to, where to go next. I'll actually just pop the link onto the chat now as well, so if you want to just click on that, you can register your interest. So I think that covers off really our points on the holding company as the main agenda points, and brings us on to the question and answer session. So we've had quite a few questions coming in, which I can guess we can go through. So the first question, I think, is one for you, Jack. I think you did cover it actually. What's your thoughts on individuals having their own holding companies, and that holding company being a shareholder within other holding companies?
Yeah, so obviously you can have, you might say, family companies as shareholders in your holding company. A few things you've got to watch. There can be some tax considerations you've got to watch in order to get the company there in the first place. Obviously, with anything tax related, you can't just move shares without consequences, so you just have to be careful on that. And it does depend on your circumstances. I mean, for some clients where that, you might say, there's not much in the holding company, it's possibly a bit of an overkill. Whereas for others, it can work very well in order to just separate out the funds a bit more into the different family groups.
Yeah, it's good. Thanks, Jack. So we've got another question. Would you advise having a holding company bank account with an alternative bank? Yeah, that's an interesting point, actually. I guess it's always in our minds, isn't it, as to maybe the sustainability of banks, etc., etc. We're not actually financial advisors, so I can't necessarily give you a complete answer on that. But I think from a practical perspective, it wouldn't necessarily, it wouldn't be a bad thing to have some of your surplus cash spread around a bit into different banks. And I think just have to remember that the FSCS protection limit that's there does only cover for groups, for banking groups. So you may just need to just check that some of the banks actually are all part of the same group, and you actually only get one lot of cover on that cash in the bank. So just be aware of that. And I think we'd recommend that if you have a holding company bank account, it's not essential, but it could be a good thing to do to have it with a separate bank account, separate bank. So good, thanks. That's a good question. So look, some of the questions here. if there's an opportunity to buy and sell an asset to generate more profit for shareholders that isn't associated with normal trading activities, would you advise it be done through the holding company or the trading company? I know what you say, Jack. Probably that one needs a bit more complex, I think, that one to answer that one.
Yeah, I was going to say it probably depends on the values and
Yeah,
how much you're talking about.
and what you want to do with the cash at the end of it.
Exactly, yeah.
So yeah, that's a good question, but probably need a bit more information on that one. Another question here is, got an intercompany account on both the holding company and trading company. So I guess you're thinking of your sort of nominal ledgers and actually having an intercompany account between the two, so funds that are built up between the two companies. Any transfers of cash show against that as a loan. Presumably that's okay. Well, I think the first point to that is what we mentioned earlier. Why have you got cash just going against as a loan? Because that was the point that we mentioned really on that one, is having that formal mechanism of moving that cash up into the holding company. So you shouldn't just have cash just going through an intercompany loan account, you might say, just per se. You'd actually would have been as a result of a formal distribution of profits, by way of a dividend, etc., or other means. Is that fair enough, Jack?
Yeah, exactly, yeah. Just to pick up on another one that's come in, can you transition from a private partnership to a limited company and holding company? And just linking that with another question in relation to about to incorporate from a partnership, should we just have a trading company until we're more established? I think really you probably find your circumstances need a review. It depends a bit on your profitability levels and how much cash you've got, for example. But it can be more cost effective to go straight from a partnership to a trading company, holding company structure. So the group structure we've discussed, that's perfectly possible. However, it just depends. For some potentially smaller businesses, you might say might be overkill at this stage, and it might be just a case of going to a trading company, get going with that, and then as the business grows, you can look to introduce a holding company at a later date.
Yeah, that's great. I think one that sort of links in slightly, or links into the point you mentioned earlier, Jack, is about succession, etc. What would you say? This question here, we're kind of already got a holding company in place, looking to pass some of the shareholding down to younger members of the family, as they're kind of responsible for the growing. As we have a holding company, does this just mean I have to gift the shares down, or is there another way? What would you say on that?
No, it doesn't mean you need to gift the shares down. You might say there's no limit to the number of holding companies you can have. Obviously, you've got to be realistic, but it sounds like you've got quite a few options from what you said. Not just gifting, because gifting might be right in some circumstances, but it's not allowing you to release any capital. So definitely think it'd be worthwhile conversation on that to look at the best way of passing those shares to the next generation, and also reviewing your options for releasing capital at the same time.
Yeah, brilliant. And another question here, which is a really key question actually. So if a subsidiary is potentially going to be sold and it's not intended that the funds should be retained in the holding company, can entrepreneurs relief, or as it's currently known as business asset disposal relief, still be used to get cash out tax efficiently? It's a great question, isn't it, Jack? That one definitely needs a bit of thought, doesn't it, ahead of time, did you say?
Yeah, exactly. Yeah. Yes, there potentially will be some options. You would need to make sure it's sort of definitely in advance. It's not exactly something you can do the week before you sell. But yeah, there will be options. We'd probably just need to discuss that in greater detail, get an idea of the structure and how it could work.
Yeah, great. Fully agree. Another question here from Nick. If you've got an EMI scheme with employee shareholders, so an EMI share scheme, this could be compatible with setting up a holding company. That one is a bit more specific, but it certainly needs looking at in a bit more detail. Usually speaking, they're not very compatible, are they, in terms of the EMI share schemes versus the holding companies? As such, you have to, they don't really work in the same way, do they? Is that right?
Correct. Yeah, it probably depends a bit as well what you're intending to use the holding company for. If it's,
Yeah.
you might say, all trader related, it might work. Whereas if you want to use a holding company for some more personal private investments, it probably won't. But yeah.
Yeah. Good. Time for a couple more, and then we'll wrap up. So value. So I think this question here: can we use a UK holding company for ownership of non-UK companies? And the answer is, again, probably needs a bit of a look at as to what those other entities, those non-UK companies are, the jurisdictions they're in, etc. But in essence, there is no reason why a UK holding company couldn't have overseas subsidiaries, if you like. We've got quite a number of clients that will be in that situation, maybe an American company or Southern Island company or something like that. Is that fair, Jack?
Yeah, correct.
Good. So yeah, don't know if there's any more questions. There's probably
Just
haven't time to answer them all. Go for it, Jack. Any more?
Yeah, just one to pick up on is, when does it not make sense for the holding company to own the property the other companies trade from? Probably depends a bit on circumstances, but there are things like pension funds where it can be more beneficial. It really depends on who you would say owns that property, what their age and stage of life is. So yeah, you might say the holding company is better than having it in the trading company because it's protected from risk, but there could be better options in terms of like pension funds, but that doesn't apply to everyone. It's just a key point.
Yeah, that's good. I think probably just time for one more, and that is, how do I know whether my shares, say here, how do I know if my shares are qualifying for business asset disposal relief, so the entrepreneurs relief? How do I know? Okay, I think that's the question.
Yes, I mean, it's not necessarily a given. It's the simple bit. There are quite a number of factors, and I think it's important that the detail is extremely important in qualifying. As mentioned earlier, we come across quite a number of situations, including the example mentioned earlier, where you might say everyone thinks that they qualify for business asset disposal relief, when in actual fact, due to you might say small technicality or due to some small detail, they don't qualify, and you are talking about quite significant amounts of tax at risk.
Yeah.
So yeah, get in touch.
Good. Maybe just this one more actually here. Can you say more about your family wellbeing trust works? Yeah, certainly. Love to talk that over. So if you just want to use that link and book a discussion, I'm more than happy to have a discussion around that, see if it can work for you. Good. No, thanks everyone. I appreciate your questions and appreciate your time in coming on today on this afternoon's event. We trust you found it valuable and helpful. Our contact details, myself and Jack, are on this slide, and we look forward to seeing you on another event soon. Thank you.